So to start, Tom asked me to set the stage regarding the current venture environment. And before I do that, and I'm going to send the first question to you, Jack, let me read a little bit of research from Steve Kaplan and Josh Lerner about what I refer to as the great venture capital contradiction. It's efficient, it's unusual, yet it's consolidating at a way that certainly most have never seen before. On the efficiency side, in 2008, venture-backed companies employed more than 12 million people, generated more than $3 trillion in revenue, accounted for 11% of the private sector employment, accounted for 21% of GDP on less than 0.2% of GDP investment. The next fact some in the room may not like, but a 2000 study found that venture-backed firms are approximately 3 times more efficient in generating innovation as corporate research arms. Bar none, venture capital is the most efficient job-creating mechanism on the planet. That's efficient. Unusual. The SBA reports that 600,000 new businesses are started each year. Venture Source reports that 1,000 businesses receive their first venture funding each year, which means 1/6 of 1% of new businesses obtain venture funding each year. And yet a very large fraction of startups that make it to the public markets are in fact venture capital funded. Since 1999, over 60% of IPOs have been venture backed, yet 1/6 of 1% of companies receive venture funding. Jack, as you know, many are forecasting that the industry will shrink to as few as 200 to 400 firms. We're the most efficient asset class on the planet. We're unusual. You've been in this industry for 30 years. What's going on?
I think if you look back, well, I'll start. I was joking earlier, but Ben Stein's father was the econ chairman here, and when I was a student, and he had Stein's law, which is when something is unsustainable, it will stop. And what's happened in the venture business was back in the 60s, you essentially had 3 families. You had the Hillmans, the Rockefellers, and the Phipps, which is Bessemer, who did venture. And they did a good job, and we built great new companies. In the early 70s, they changed their ERISA pension laws. And Larry can talk to it, but it was deemed prudent to have a diverse portfolio of which a component was highly risky. So that opened up the era of institutional venture capital. And you had these large pools of money at Kleiner Perkins, like they were $12 million funds. And they did a pretty good job. And then in the 80s, Ben Rosen put $750,000 into 2 companies a week apart for half the companies. One was Compaq and the other was Lotus. And they made a bunch of money. And the money just poured into the asset class. The industry probably got up to maybe $400 or $500 million a year. There were 4 mega funds. It was Brentwood and Rothschild, H&Q, and Norwest. They raised $100 million, which nobody thought you could possibly put out that much money. And the returns went to hell because there was too much capital. So in the late 80s, capital dried up. You had some firms which survived, which are kind of the brand firms today, that had funds that were $100 to $200 million. And they were the only game in town, and in the 90s they nailed it. And these were 10 and 20x funds. So venture started to pour into the business. It was $100 billion in 1999. But I did a bottoms-up analysis for our limited partners, which was very controversial. But the last year the venture business was actually profitable was 1997. The industry as a whole put out $3 billion, the top firms, and we returned $9 billion. And in 1998, we invested $4 billion and we returned $8 billion. $4 billion of that came from one firm, from Matrix. And then after that, we've been putting out $25 billion a year, and for a decade we've been talking about how we now rationalize the industry. But the returns still aren't there across the asset class. So you're seeing the traditional funders of venture capital, which are primarily endowments and universities. There are 2 universities that are built on venture capital, University of Richmond and Yale. And everyone followed what's called the Swenson model and over-allocated. And in 1998, when the markets went to hell, we all kept doing deals. We kept making capital calls, and they had to sell public stocks in 1998. So a lot of people said, never again. And so you're seeing the traditional investors either drop the asset class or give their money to the firms that are in LinkedIn and Facebook, and a handful of firms who are raising $1 billion+ funds. and then you're seeing the capital everywhere else essentially dry up. And this is driven by what's believed to be a new era of fantastic returns from a handful of IPOs which have either not happened yet or haven't been turned to liquidity. So the capital that used to be risk capital, that I would call allocation capital, I have to put 5% in VC, is going to Silicon Valley and to a lesser extent to media in New York. But there is no more venture capital in Atlanta or Raleigh or Pittsburgh or Philadelphia. It's literally all getting sucked out to the valley. So I think what's interesting about our business is we talk a lot, but we're not very transparent. So you don't really see what's happening underneath the numbers. But I'd like to talk more from the institutional standpoint. But I have a limited partner, a very large Northeast telephone company. And they're laying off so many people who are taking their pensions in cash that their allocation of private equity is now zero. There's an extremely large funder funded by an eccentric pilot in Maryland that funds a lot of healthcare research. They're done with the asset class because they haven't been paid for their liquidity. There's an Ivy League school in Philadelphia. They're done with the asset class, and so I'm seeing this just happening across the industry. So at the same time we're talking about Facebook and LinkedIn, the business is being fundamentally transformed into a handful of billion-dollar funds who I think are going to be very challenged to generate venture returns and then avoid.
Larry, I hear there's an endowment at a university founded by Thomas Jefferson. What are your peers doing? Are they running from the asset class, or are they running to something?
Yeah, I think it's mostly running away. Just to give you perspective on our returns, we did very well, again, back in the 90s, like Jack suggested. And if you look at this will illustrate that, if you look at our 20-year returns ending last month, our 20-year returns from venture were 17% per year compounded. If you look at our 10-year number, it's 0%. So you can see which decade that occurred in. With that said, that 0% is still not our worst asset class during that 10-year period. Real estate managed to win the award for the bottom performing asset class. But if you look at what we're trying to do, which is knowing that not everything's going to work out, and you're trying to invest that illiquid part of the portfolio, and we feel like we can be an illiquid investor. We are a long-term pool of capital. We're the type of investor that we don't need to, and we shouldn't be reacting to everything that's going on in Europe, et cetera, et cetera. But we want to be compensated for that illiquidity. Where we've been compensated for the illiquidity has not been in venture the last 10 years. It was the last 20 years. But looking forward, you might get to the point where venture is right-sized. Clearly, the supply of capital has gone down as people get out of the asset class. And even say, Stanford, which is right in the backyard, they've not pulled out of the asset class, but once they got to a certain size, and knowing that they only had these minuscule allocations that they could get from the funds they wanted to get into, it wasn't really moving the needle as much. And so it starts becoming a little more challenging when you're investing $20 billion or $30 billion. And so that's why some investors are gravitating to those mega funds. But at our size, at $5 billion, we can still have some allocation to venture, knowing that it's not going to be as meaningful as some of our other illiquid investments, where we really feel there's a greater conviction in that we're getting compensated for the illiquidity. But I still think it's going to give us exposure to a certain sector of the economy. We're doing it with different managers. We were in a number of the premier managers that got to the billion-dollar size. We're no longer in those managers, and have looked to get into really an earlier stage manager that are funds in the $50 to $100 million fund size. And still having a small allocation, we're still going to be in that game, but it's not going to be the lion's share of our illiquid allocation.
Doug or Mark, what's your sense? I think on one of the previous panels they talked about this creating sort of the haves and the have-nots, and I wonder if there's a third, which is, boy, I wish you were here. which is you have the contraction of the venture capital industry, and then you have these billion-dollar funds sucking the rest of the money out in California. For them, they've got to put 50 to 100 million in a company to make sense. What about the companies that really only need 10 to 20 million? Is there going to be an impact on that for some period of time, in your opinion?
Well, you want to take it?
Let me start. Let me just hit one thing is that there's three reasons why it's contracted so much in the last 10 years. One is too much money chasing too few deals. Two is the one you hear about all the time, which is lack of exits. And certainly with Sarbanes-Oxley, there were dramatically less IPOs, the last 5 years, and certainly than there were in the late 90s during the go-go years. But the one piece of the puzzle that people don't really talk about that I think is very positive for even though it's bad for VCs, it's positive in general, is that it's so much cheaper these days to start a company than it was 10 or 15 years ago. It's literally, they've done studies, it's about a fifth or maybe even less than a fifth is expensive because there's freeware, there's cloud computing. And what's going on is a lot of these people that used to take $1 million or $2 million of venture capital can now do it on a shoestring. Lean startup is the key right now in entrepreneurship. And basically, they can get started with just their own money, friends and family money, and that shuts out a piece of the places where these VCs used to invest money. And because of that, what's happened is these people can make it to a certain size and get a certain amount of traction. And a lot of these big names that you hear about getting taken over for $1 billion in a year and a half and so forth, started with just type seed money. So what's happened is you're right. There's the big firms that now have very few bets and have to basically make these large bets to deploy that money. I think this is going to continue. I think it's going to get cheaper and cheaper to do this. So unfortunately, I think you'll see more and more angels come in. I do think you've been seeing that, but I do think the funds that can invest the 5, the 10s, or 20s, unfortunately, it's not going to come back. I think that the fact that it's gotten cheaper and easier to become an entrepreneur is great for the economy. It's great for would-be entrepreneurs, but unfortunately, it's bad for venture capital.
So let's talk about that more. I heard someone call that the other day the Budweiser theory. I think most people remember the Budweiser commercials: "Tastes great, less filling. Tastes great, less filling." And their metaphor was basically less filling is less capital. Tastes great is great returns, right? It was interesting on a Thursday night near the corner. But I guess the question is, what is this Budweiser theory? How is that changing the innovation at that level? And maybe over to you, Doug, from Silicon Valley. We've got Y Combinator, we've got tech startups.
Yeah. Well, it's interesting. So my company, Shazam, is headquartered in London, but I'm based in Palo Alto and have been out in Silicon Valley now for the last 12 or 13 years, and I was there before then as well. I would have to say that from an entrepreneur standpoint, and before joining Shazam, I was working on a payment startup and working with a lot of other startups. There doesn't seem to be any shortage of venture capital if you want it. There are plenty of sources to go out and raise. There's what is interesting though is this kind of barbell issue that we're talking about. There was always angel money available, and then there was a rise of the so-called super angels. The investors who got in and said, that mid-stage or later stage venture investing, that's too crowded, I'm going to go early. I'm going to spread it around, and if I get a big hit, like a Facebook or a Google, I'll just make it several times over. I just don't know how to do it, so I'm going to put hundreds of thousands of dollars at work in lots of different places. And that just continues to build and is a big trend, in part because of the capital efficiency of starting up small companies now has been briefly discussed and much publicized out in Silicon Valley. The interesting thing about that, though, is what I now hear out in Silicon Valley is that area is getting crowded. The initial, more celebrated super angels are now just saying, I was a super angel first, and we've got all these other people coming into it, and now I just can't get a return as a super angel. So that is becoming interesting, and you see competition there. On the other side, you do see these great big investments that are done by some of the big firms at what are apparently crazy, what look like crazy valuations, where you can bet there's some sort of dynamic going on with the entrepreneur where they say, I want to write a check for $50 million, and the entrepreneur's doing the standard math on dilution, going, crap, I'm not going to take that much money. I don't want that much dilution. And so that is in part a factor driving up valuations, and these firms fight to get in these hot deals. And as I've talked to my friends in venture capital about some of these really high later stage valuations where enormous amounts of capital are going to work, and when I say enormous, I mean 50 million or higher. You hear the rationalization of, well, I'm top of the preference stack, and I'm sure there'll be a liquidity event for at least this much, so my downside is minimal. And I can live to fight another day. Last point I would make, by the way, going on is that it sure also feels a little like there is some momentum investing going on. I'm not a public market trader, but there's that going on. But it sure feels like it on the venture side as well. The hard startup, got to get in, and it's almost a greater fool theory. Yeah, crap, you know what? I'm paying a huge valuation, but I think it's going to be frothy for a while, and somebody's going to bid me up in the next round.
How does that end?
What's that?
How does that end?
Well, it depends on whether you believe there's a bubble or not. We know how the last bubble ended, which was a big crash, but it was sure fun while it was going up. It feels kind of fun out in Silicon Valley right now. I think just when you expect maybe the fun might end a little bit, boom, Instagram hits. I know it was mentioned earlier today, $1 billion acquisition. Company's barely 2 years old. Got a number of users, nifty app, but no revenue. And from friends I know who looked at Instagram, their revenue plans were sketchy at best in terms of this last round they did. So you think, God, okay, well that just got bought. And you can rationalize it. You can say, well, Facebook is going to be a $100 billion company, 1% of market cap. They took their competitor out. We talked a little bit about that. But boy, that feels frothy.
Well, and my understanding is that they were $1 billion on Sunday, and Sequoia valued them at $500 million on the previous Thursday. But
yeah.
I want to come back to that a minute when we talk about the youth in America, if you will. Let's talk about the Valley for a second. There was some data I pulled before I came here. In 2011, Silicon Valley represented 41% of U.S. venture capital dollars and 32% of U.S. deals. New England was a distant second with 11% of total funding and 12% of U.S. deals. Taken together, Silicon Valley, New England, and New York accounted for 62% of venture-backed funding and 54% of the deals reported in 2011. Does Silicon Valley have a monopoly on ideas? Do they have a monopoly on money? Is it the weather?
Well, the weather's definitely great, although it's been crappy this last April. So
it's been a wonderful winter here, by the way.
Yeah, so I understand.
Should come back.
Exactly. So certainly it doesn't have a monopoly on great ideas. What it does have is a very well-developed and concentrated ecosystem. For those of us who want to see more entrepreneurship going on in Virginia, in Charlottesville, at the University of Virginia, it's just such a stark contrast. And I've been involved in trying to help get entrepreneurship and some programs here started up. We mentioned that earlier here at the University of Virginia. And it's astounding to me when I go and talk with students who, I'm a University of Virginia graduate, 2X, and I guess we all are. I bet we all think we're pretty smart. So it can't be because Silicon Valley is smarter or there's good ideas. But I'll tell you what, students, entrepreneurs have access to people. They have ready access to capital. There is an understanding of startup environments. Entrepreneurs' successes out there are celebrated. Yes, Goldman's out there, Morgan Stanley's out there, McKinsey's out there, all good. But, man, you don't hear about that. Everybody's looking at Kevin over at Instagram, who's now worth $400 million, going, I can develop that kind of an app. So I think that's one of the big things that happens. Two, I think there's a lot of great mentorship out there. There are so many other successful entrepreneurs, successful venture capitalists, who if you're thinking about starting up a company, you can find people who help you right away. And then there's also very much an understanding of cycling through ideas, cycling through companies, failing at some, succeeding at others. You'll talk to somebody and they'll say, well, what have you been doing for the last couple of years? Well, I made a great go at this initiative, finally had to fold up because of the following reasons. Not a black mark? Good for you. You got out there and tried. You learned some lessons. How are you going to apply that to the next go-around? So that ecosystem advantage, I think, is quite significant.
Mark, you've got to have thoughts on this, having built some wildly successful companies here on the East Coast.
Yeah, no, I love the West Coast mentality. And all the kids at Stanford want to be entrepreneurs. I mean, and they have the role models out there. And unfortunately, on the East Coast, especially an institution like UVA that's steeped in tradition, being an entrepreneur is not the first thing on these kids' mind. Getting the job at McKinsey or Goldman is first and foremost. And the thing is, but because they don't see those role models and they don't see the people who've made a lot of money and had a lot of fun doing it, it's tough to get that into their heads. We're certainly trying, certainly we're trying at McIntyre to change that perception and getting people who've been there, done that, to come back to the classroom and teach. But that's what we need to do in Charlottesville. And I think we can, but it really is it's about a mindset, and the ecosystem can be built, but it takes time. And but the point is, at the end, every entrepreneur I know, whether they've been a success or a failure, is happy that they did it. And once again, it's the mentality of entrepreneurs that failure is fine. There's no problem. There's no negative stigma whatsoever in failing. It's because you're out there and you're trying and you're giving it your all. And so that's the kind of mentality that you have to have. And we're trying to get it here at UVA.
Yeah, the ecosystem here and the mentorship, we talked about this the other day, is really geared around to hedge funds. I mean, we have a lot of alums that have done very well in hedge funds. And again, it just becomes this virtuous circle. It just becomes self-reinforcing, and that's a good thing. I mean, I'm glad we have alums in that, but you could use that as a kind of a model for what could happen on the venture side or the entrepreneurship side. It's a very good model. So on the technology side, fortunately, we invest in hedge funds too. They've done well. And I hope eventually there is a bubble in technology, because one of the things that leads to is fertile grounds for our long-short managers to make money on the short side, on the public securities. So it becomes a virtuous circle on multiple fronts.
So you make money either way.
We can make money. Well, if you go back to 10 years, we had a very good 10-year run on the venture side. We then really took a lot of the gains, and then we made a lot of money on the long-short equity side for the following several years. So there's going to be an asset class for us, we're a diversified investor, that's going to pay off.
Yeah. I think there's two other big things that have happened that are a little bit more subtle. It's not official, but at Stanford and MIT, to make tenure, it's not just publishing. You have to have ideas that lead to companies, or you're just not going to earn your peers' respect. So it's part of the culture. The other thing that's changed, I grew up in the 60s, and in that generation, people's dads worked for IBM, which stood for I've been moved, and people moved every 2 or 3 years, and the spouse was a school teacher, so she was portable, and all of us swore we were never going to do that to our kids. And so what happened is, and now people's spouses have careers, real careers, and they know they're going to work for 5 or 8 companies and have 5 or 8 gigs. So people want to move to a city where their spouse can reach their professional potential and where they can see their next 8 gigs without having to pick up and move their family again and again and again. So the rich are getting richer in terms of the cities, Boston or Washington or Los Angeles or the Valley. You could build a full career there without having a clue what your 7th job is going to be. And your spouse can reach their potential. So, one of the probably most innovative pieces of technology we ever backed was down in Melbourne, Florida. It was in 1997. These guys redesigned CDMA from the ground up for data. Nobody ever thought of that. And we ended up with 120 patents. We didn't make money on the deal, but InterDigital's first defendant, Lucent, paid them $600 million for our patents. We couldn't get a CEO to go to Melbourne. Because what am I going to do next? Go to work for Harris or NASA? That's your choice. So I think that's part of it too. And there is, I was at a couple weeks ago at a fund we're both invested in. That's kind of hot right now. And there's very much a gold rush mentality. A lot of greed, a lot of fun, a lot of blowing smoke, a lot of unhatched chickens. But it's attracting professional managers because of the family stuff. But it's attracting just a lot of really bright, really young, really smart, really greedy kids who would have been at Goldman 5 years ago. Yeah. They think this is where the money is.
So there's a lot of PhDs and students in the crowd as well. Let's talk about this a little bit more. It's easy to talk about risk. I saw like a quote. No panel would be complete without quoting Jefferson, so I've got to do it. Democracy itself guarantees nothing. Instead, it only offers the opportunity to succeed in the risk of failure. And we're here talking about venture capital and startup, riskiest asset class on the planet. Let's say I'm a graduate of the university, which I am. I study under the great Professor Overstreet at McIntyre School, which I did. He's been one of my favorite. I punched my card at Goldman. I study at Harvard. And along the way, you're taught about risk a lot. Risk-free rate, adjusted risk-free premiums, so on and so forth. All risks that you can put in a spreadsheet. And I think we all would having done what you've done, it's hard to imagine putting creativity in the creation of a company and fitting that into a spreadsheet. So what do you say to folks in the audience that have a great idea but have never tackled risk? What does risk feel like? How do you it's sort of this mystery thing that really the only way I was ever taught about it is how you fit it in a spreadsheet. But how do you? I've got a wife who's expecting in July. If I had a new idea, which my brother-in-law did, he moves out to Denver because it was a medical device company, doesn't get FDA approval, thinks they messed up the process, moves his entire company out while his wife is pregnant. His mother is going absolutely nuts, and a year later they get approval and they send it for $700 million, Kaifan, and Medtronic then buys that company for $900 million, and now he's naming the boat after the head of marketing that didn't take the deal. But he took risk. What would you say to folks on how do you demystify that? He got comfortable with it. How do others get comfortable?
I think if it was easy, everyone would do it. I mean, it takes a special kind of person. My view is the people that start the great companies, it's not the guy with nothing on the credit card. And it's not the CEO of a successful company. You get a company like a Blackboard that probably produced 100 people that made $500,000 to $2 million. And they're young. There's no risk in taking a year off when you have $1 million in the bank. Those are the guys who start the next companies. The guys we fund, after our first meeting with them, when they walk out and we look at each other and say, these guys are going to do this with or without us and succeed, those are the guys we fund. And almost every time after the first board meeting, you know whether you picked a winner or a loser at the first board meeting. And one of the ways you know, and Blackboard's a good example, we've made a lot of money on 3 deals where they blew the numbers out at the first board meeting. And how can that happen? They lowballed us while they're negotiating valuation. They left valuation on the table because they had a culture of beating their promises. And those are the kinds of folks that are just...
So you're just born that way, Jack, or can you be taught that when you're at the university and you're an undergrad or even in high school or junior high? Can you be taught to take risks?
I think it's the values you get from your family. That, it's not about me. It's about my team. It's about my legacy. It's about changing the world. It's not about getting a 15% higher valuation and missing my numbers at the first board meeting.
What do you think, Mark?
I think half of it is that, but so a lot of it is your own DNA. And there are certainly people who are bigger risk takers, and certainly families where their parents were entrepreneurial are more likely to become entrepreneurs themselves. You certainly hear time and time again that the biggest regret that people have was not taking the risk, not doing something. And so I think, a lot of people need to take that risk. And certainly it's been proven in America, if you want to make big money, you have to take some risk. But a couple things. One is that for these graduate students and undergrads and people recently graduated, this is the time to do it, guys. You don't have the pregnant wife, you don't have you don't have the mortgage. Now is the time when you're used to living cheaply is to take that risk. Two, because of the entrepreneurial culture, certainly on the West Coast, but I think throughout America now, there really is no stigma for trying and failing. So the thing is, the worst case scenario is, you try, you fail, a year and a half later, someone will give you a job. I know certainly as an entrepreneur, I'd rather see someone try and fail. I'd rather hire that guy than someone out of a big bank. So from that perspective, I think that's part of it. And the third thing is yes, I think if you have entrepreneurs, and we certainly do at McIntyre. We have, people who've been successful entrepreneurs and venture capitalists teach, and then we bring people into the classroom who've been successful. There are ways that you can look at risk and mitigate your downside. And there's been actually good work at Darden in terms of that serial entrepreneurs that make money think of it not about how much money I can make, but they think about how much risk I'm going to take in this endeavor. And the serial entrepreneurs that have been successful are always trying to limit their downside risk. They're always trying to say, okay, I can afford to spend this much, and I'll see what I get, and at that point I'll iterate or not iterate. But the point is, they're not saying I'm going to go out and make $1 billion. They're saying I'm willing to risk, no salary for a year and a half. I'm willing to risk my $20,000 that I've saved up over the last 2 years or whatever to take the shot. And that's the kind of thing you have to do. And I think at places like McIntyre and Darden, you learn how to look at a venture, fail fast if you're going to fail, but more importantly, what can I do to mitigate my risk along the way?
So you hear fail fast all the time. I'll come back to this.
This comes back to the comment that was made earlier, which to me is this big scary monster in the closet. So it is really cheap to start a company now, and we've been having daily board calls with company IBAC. Two guys with an idea. There's $4 million all in. We've got 45 million users. We're doing $1 million a month. We're growing 100% a year, and we're profitable.
Nice.
It's very nice. Yeah. Except now I got to worry if anybody finds out about this company that Bessemer or Kleiner or NEA will go get guys who are not as good as my guys or better than my guys and give them $50 million and wreck my company. So it's
Steal
easy.
your guys.
It's easier to start a company now, but then you got to worry about somebody coming in with $50 million and wrecking your business model. And so that creates a real dilemma too. Just because you can start a company cheap doesn't mean you can get to an exit.
Well, that's true. By the way, on the risk point, just riffing on a point that Jack mentioned, he said, these guys are going to do it anyway, right? There's certainly an attitude that I see with successful entrepreneurs who, it's not should they do it, it's how can they not do it, because the opportunity is right there. And so there's, it's DNA, it's, I don't know, some spiritual divine intervention that says you just got to go out and do it. Not sure. But I would also say, and this goes back to kind of the Silicon Valley point, if you've been watching the area long enough or been part of it long enough, you're going to have a failure. You're going to have some successes. Your successes you'll probably over-index on financial success with the successes than the study as she goes. Now, averaged out over a period of time, who knows if you come out ahead? I don't know. You certainly have the opportunity to come out more. But I think that there's an attitude, again, of saying, I'm going to jump into this, and, I'm going to go X years with, no or very low salary. Could work out, could get a big payoff, may not hit. Doesn't hit? All right, fine. There'll be another one that'll come along, and I could get a big hit. Or I also have friends who do this. You can see them do it. They'll go out, they'll give a go, they'll get a hit. It's great. They go try something, maybe it fails. Go back to corporate for a couple years. It's like, oh yeah, there goes Don. Don's off to go just make some salary for a while because it's been kind of dry for a couple of years. So I think, looking at it over a longer term, I think if you're an entrepreneur as well, and recognizing those cycles, that can help you get over it.
What do you say to the professors in the audience on, everyone says fail fast. It's good to fail, it's okay, but it's one thing to say that. How do you teach someone that it's okay to fail? Because I actually don't believe you're just born with this. Because maybe in California think that, but everyone in California is teaching this, so it's really easy to say you're born with that because all the teachers are teaching sort of this innovation religion. What would you say to the professors here? How do you bring this idea of being free to fail into the University of Virginia?
I won't name names, and this was many years ago, but I was getting pitched by a dean here. He was pitching me and Tim Draper. And Tim said, you're going to take 2 years off to do this, right? And the dean said, oh, it's much too risky for that. And Tim said, if it's too risky for you, it's way too risky for me. And then he looked at me and he said, you look awfully familiar. I said, you were my data structures professor. And he said, I hope I gave you an A. But if you're not willing to take 2 years off, it's too risky.
Interesting. There's a couple things about that, though, right? Certainly, if you are in science or technology, you learn that a failed experiment is progress. Certainly. And I know that is taught. I don't know if the speed issue is taught, but I definitely can distinctly recall from my curriculum that, failed experience is moving ahead. So I think that's an issue. But going back to this role model issue, and again talking about, I think the point you brought up about MIT and Stanford, there are professors at those universities, lots of them, and I'm sure they exist here too. I know Tom's one, who have succeeded with ventures, have helped start up. And those are great role models for students who, you can go to and not only learn core subjects from them, but see how that science or technology or business concept or art can be applied to commercial gain. And I think, we need to do, I know a few, but I don't know as many as I bet exist here. Finding those folks, getting them celebrated, making sure students know who they are. So if they don't happen to be taking their class, boy, I'd get on office hours and talk about how it can be done.
One thing I worry about, and it's become so competitive now to get into an elite university. My peers.
Hell, it's competitive now to get into
a bad university.
Yeah.
Preschool.
They've got these kids. They've got their kids in squash class, and at 4 years old, because they figure if they're a squash champion, nobody plays squash anymore. So these kids become test-taking machines, and the classes are carefully picked so that they can have their 4.0, and there are 2 or 3 times as many kids who apply to Berkeley with 4.0s as there are slots. And
Yeah.
So I think people have become so focused on this superficial, I'm an A player stuff. I'm finding these entrepreneurs who are 30 years old with these incredible pedigrees who don't have a creative bone in their body. And I would encourage people to go outside your comfort zone.
Well, they've never been put in a situation where they failed.
But they've engineered it so they've never been in a position
exactly.
where they failed. But
Never took a chance.
Take a class where you're guaranteed to get a B-,
Right.
and take the art class, and take the computer science class, and do some stuff where you can fail. And then the admissions people here need to take a couple kids with 3.8s just so you get those wild ducks.
One thing I would just tell the students here is that, you don't have to have a brilliant idea. As a matter of fact, my 2 biggest successes have been sort of Me Too ideas where there were other people in this industry, I just did it better. But more importantly is if you don't have an idea, go work for a small, high-growth startup. The learning experience you'll get will be unbelievable, and you'll see if you have the chemistry for it. In the Valley, you're working 16-hour days. Not everyone is sort of meant to be working a 16-hour day, but the point is the guys who do it and love it, they get the adrenaline rush, and they love working 16-hour days. And it's kind of hard to find people, when you talk to high school seniors, and you tell them, I work 16-hour days, and they look at you like you're got 2 heads. But the point is if you work at a small startup, the experience will let you know whether you have the DNA to do it yourself, be the CEO, and take a risk, and you'll know. So the thing is, you don't have to be the guy with the idea or nothing. Now, obviously, small startups don't pay as well as Goldman or McKinsey, but the experience, I've worked at those kind of firms, and the experience you get at a small startup will be better than working on the street.
So what guidance would you get? So one thing I observed about all 4 of your careers was a sector focus very early on. Financial services, mobile and products. Jack, you've been in the company building business since the beginning, and there's trends to areas that you focused in, education as one, financial. If you're under 30, and you're Kevin focused on photo, right? Mark Zuckerberg started from the beginning. So one of the decisions they're being forced to do is pick a sector early on. Even GE, who was king of the generalists, is now coming out and saying, no more generalists. You want to be a specialist. You're under 30, you've got to pick a sector. As you're thinking about the next 20 years of growth, what are the sectors you think are worth folks dedicating? Because that's a bet they've got to make maybe early, maybe.
When I was growing up, and my father was class of 52 at West Point, and he said, what the world is going to need is translators among specialists, because it's becoming too complex that anybody who's sufficiently expert in one area is not going to be able to communicate articulately with the other team members. So my sons, I'm encouraging them to study engineering, but I'm encouraging them to study everything else too. Because becoming a specialist in a certain field of mathematics to start a company, either win or you lose. But if you can explain to an engineer what a marketing guy needs, what margin is, what scale is, what a network effect is, all the pieces necessary to build a business, then I think you have a portable skill. So I think you want a technical background, but I think you want a broad background. I mean, you've got to take an accounting class to understand bookkeeping. I mean, everybody has to take an accounting class, but you typically wouldn't think that way. So the most valuable people are going to be the people that can get the specialists to understand what each other needs to execute a company.
And I would get, I'm not an entrepreneur, so I'm speaking from an investment perspective. I think to be a great investor, it's as opposed to being a specialist. There's certainly specialists who are great investors. I think it is actually valuable to have had a range of experiences. Aside from the range of academic experiences, a range of experiences having worked for a corporation, worked on Wall Street, worked on a number of positions within finance. Too many people, they have a route. They go to McIntyre, they go to Goldman Sachs, they go to a private equity firm, and they just stay at a private, or they go to a hedge fund. They're just at a hedge fund. They've never really had a kind of a full experience of working within a company, large company, small company, and I think it becomes a little limiting in the way they view the world. So having, I think, a broader set of experiences makes you actually a better an investor as opposed to an entrepreneur, a business person, a venture capitalist. I think it's potentially a different skill set. We're looking to hire some narrow specialists, but I think you need to have a broader perspective to be able to put it in the context as how attractive is venture? Are you being compensated for the illiquidity relative to the other things that you could be doing? To answer some of those questions, I think you need more of a general, broader background.
What I tell people is do what you love, because if you do what you like, you'll work those longer hours. You'll be successful. For me, when I was in school here, undergrad in finance, everyone went into banking, and few people went up to Wall Street. Well, I went up to Wall Street to look around, and I saw the pits, the trading floor, and people yelling and screaming and getting hoarse and getting pen marked. And I said, that looks really cool. That looks like fun. I mean, that doesn't even look like a job. You get to yell and scream and buy and sell, and so that's what I did. But because I'm an entrepreneur, less than 2 years later, actually, I was on my own doing it. So the thing is, but if do what you like, do what excites you. And the rest, if you're smart and entrepreneurial, the rest you'll figure it out as you go along. But you got to do something that interests you, because you won't spend 16 hours a day doing something you don't like. Like, I could never be an accountant. I could do 3 hours a day being an accountant, let alone 16 hours a day type thing.
Yeah, and I agree with you on that too. What do you love? So a couple thoughts. One, you're right. I've been in mobile now for, I heard earlier Mark was saying he'd been in mobile since 1994. 3 years on you, 1991. There were 6 million mobile phones back then, and the car phones were still there and the transportables were there. I loved it. It was great. There was just something about being able to talk on an untethered device, and I just thought that was great. That lasted 10 years for me when I was actually in mobile operators. And I just had such a strong affiliation to the industry, but I was doing so many different things. I started out in strategy in a corporate development group where everybody was an ex-banker or an ex-consultant. I ended up living in Charlotte, North Carolina, running a region for Sprint PCS, managing stores in the blue shirts at Best Buy. Radical. But after 10 years of growth, which was fantastic, I kept thinking there's something to this internet thing. Maybe I had to go figure that out. And I thought, I got to get out to Silicon Valley. I need to get in on the website. How can I do that? Now, at that point, I certainly wasn't on Kleiner Perkins speed dial to go into one of their startups. I was slinging phones in Charlotte, North Carolina, and Richmond, Virginia. So how was I going to get out there? Well, I found somebody who would take a risk on me. I found my way into a web company. I ended up at Yahoo, running broadband and mobile for Yahoo. And quite frankly, when I went into it, I didn't know the difference between a browser and a portal. They would ask me, what's my favorite web destination? And I would say, I don't really know. I don't really have one. But isn't that a problem for Yahoo? So I did develop interview skills. And then I got into that. And ironically, 4 years later, I ended up inside Kleiner Perkins as an entrepreneur in residence, helping them start up mobile. I'm in Shazam. I'm at Shazam now. It's mobile, but it's music entertainment. I spend my time with TV programmers, TV networks, negotiated a deal with Madonna's management, LMFAO, Interscope Records, and Bud Light all at once. I got to tell you, that sure wasn't on my radar when I started in cellular. So it's been mobile, but constantly reinventing as you kind of look at the new thing, but excited kind of every step of the way. So I think one of the things is if you're going to be an entrepreneur, you're going to look for new challenges. You just got to have that passion for learning and something new. And I think that's really important. With regard to your point about generalist versus specialist, this I'm always reminded, and I won't get the quote exactly right, but they say, should you be a generalist or a specialist? I say, well, if you're a generalist, you want to learn a lot about a lot of things, but not go deep. And to be a great generalist, you learn about more and more, but you go less and less deep, till finally you know nothing about everything. Yeah. Or you could be a specialist, and there you go really deep, and you know more and more about less and less, until you know everything about nothing. So I don't know where you fall on the spectrum, but I think both can be fun, and you end up with nothing either way. So
we a couple of us, Doug, I think that you were there. We opened the Open Ground Studio with Tom and Bill Sherman a couple weeks ago here. One of the things they talked about, and some advice I got, is asking the right question, figuring out the right question. Jack, I'm going to come to you in a minute because I love give advice to folks on how you figured in your venture career to ask the right question, but you've got to tell the brief Steven Spielberg story on asking. You said you had good interview skills. Maybe you could tell a short version of your Spielberg interview
story.
On getting Yahoo started.
Yeah, that was kind of a fun story. So I talked a little bit about some of the things that I'd seen in my career, and I started this pitch by saying, what does a phone company and Raiders of the Lost Ark have in common? And the punchline. It eventually gets down to Steven Spielberg. I was at Yahoo, and we had just produced our portal experience for broadband. This was when broadband was just developing. And we were all trying to figure out what should be at the end of the pipe. Everybody remembers the dial-up days and what portals looked like and lots of links everywhere. We were trying to come up with this broadband experience. And I got a call from Terry Semmel, who was our CEO at the time. Terry had previously been co-chairman of Warner Brothers, Hollywood, literally a Hollywood mogul. And Terry called me and he said, hey, Doug, I want you to come up to the conference room. You need to give a demo. I said, okay. We want to see a demo of your new broadband portal. Terrific. Who's it for? I can't really say. And I said, oh, okay, well, that's unusual, but I was quite used to giving those. So I got my computer and, had my demo script ready, and I walked up, and there at the end of the conference room was Steven Spielberg. And I just, first of all, I couldn't quite get over it. I mean, I knew Terry knew movie guys, but here was Steven Spielberg. And I went through the experience. And you think about Yahoo as a technology company, you think about it as a media company, and here we had this great movie director who, after going through the experience, said, Doug, you've shown me this feature, you've shown me that feature, it's got this functionality, it's got that functionality. Fine. Not exciting. You're not engaging me. You've got to engage the user. And then we had about a 15-minute discussion on how you engage the user in this immersive experience. And it made such an imprint on me. And we went back and we redid our portal. We eventually, I think as I mentioned during the open ground ceremony, we created inline video in the portal for the first time. It was like a Harry Potter newspaper coming to life, which happens all the time on the web now, but was very unique. And there was a great example, I think, of talking about multidisciplines, how really a technology-based company, maybe on its way to becoming a media company, got this artist, this great creator of film, who came back and influenced this portal, which we eventually deployed with the phone company, SBC, which is now AT&T.
So Steven knew the right question to ask. And
great point.
How do you figure that out, Jack, as you're looking at investments? The world's sort of your oyster. How do you know the right question to ask?
Well, I think the first thing is, in every company, in every deal you're looking at, if there's more than 2 long poles in the tent, you can't do the deal because it's just too many moving parts. So the first thing is, what is the long pole in the tent? Must it go viral? Do you have to raise $100 million? Is it a chemistry thing? There's something that has to happen, and that's to make the magic. So that's the first thing is to figure out what is the long pole in the tent that is going to make this a profitable, sustainable, flywheeling kind of company, because that's something you could measure. And it varies in each company. I mean, and if what we call a physics deal, it's a better mousetrap. It either works or it doesn't. And if it's an existing product, existing market, and I can do it twice as fast for half the price, I win. So now the question is the chemistry or the physics or the electronics. What has to happen for this to work? How are we going to know if it doesn't work? How cheaply can we find out if it doesn't work? But there are other deals where there's a network effect. I mean, Blackboard. The big questions at Blackboard were, will universities spend money? We were the first ones to go to an annual license model, 100% every year. But it ended up in a point, and I mean, Providence took it private, so I can say this now, but it's essentially a monopoly. All the content guys had to write to Blackboard, even though there were free alternatives, because they had 80% market share. And all the schools had to buy it because that's where all the content was. So that's a flywheel network effect kind of business. Can we get enough share quickly enough? And we followed the Microsoft strategy, and we explicitly talked about this at the first board meeting, that if Microsoft had gone into spreadsheets and word processing early on, there'd be no Microsoft. They tricked Lotus and Ashton Tate and WordPerfect to make their operating system a platform. And our explicit strategy from day one was to be the operating system of higher education, so that the application environment that builds on top of our operating system locks us in. So the long pole there was,
what's amazing with the Microsoft analogy is Michael Chasen and the team of the board went out and bought the 2 largest open source providers last week, which would be the equivalent of Microsoft buying Red Hat. So they're still innovating and changing the game.
Well, these guys were 24-year-old kids when they started the company, and they came to us and they said, I don't know, I must have been 39. You old guys don't get it. This is all about eyeballs. This is a land grab. And I said, you don't get it. This is enterprise software. This is all about annual license fees. And they're smart guys. They got it. It's all about annual license fees.
So at that Open Ground studio, Tom, this was a couple weeks ago, and then we'll open up for questions from the audience. Rita Dove, who's the former U.S. Poet Laureate, Pulitzer Prize winner, read an inspiring poem that ended the following way. We're all going to places true but unproven. And then before we were talking about questions, before we left that day, Bill Sherman asked us to write on the board a question that we all had. And mine, as I was departing, was when we sit down 10 years from now, assuming Tom invites us good-looking guys up here again, when we sit down 10 years from now, what will the University of Virginia and its various innovation efforts have proven to be true? So reminding you that all of you have earned the right to be very critical. You've got deans, you've got professors, you've got the leadership of the university in the room. And Mark, let's start with you. What would your advice, your candid advice to the University of Virginia on what radical, not incremental, but radical changes they need to make?
You need to get the various schools working together more. As a matter of fact, Doug and I just had this conversation an hour ago. That right now the way, and actually what's great is President Sullivan is addressing that issue herself, and actually it's going to change within a year to let the money flow with the students. But the point is, right now there's no incentive for the schools to work together. And in the real world, there's business guys and finance guys and techs who work together. I mean, that's every company that starts these days has a mixture of those and artistic types, and the thing is, you've got to get these schools to work together to foster entrepreneurship, and that's the thing that UVA has to do is create the culture of entrepreneurship. Celebrate entrepreneurship, celebrate it, but get these schools to work together so that engineering kids can work together with McIntyre kids and a kid from the college and form a group. And that's the kind of group that would be a real company, not 5 kids from McIntyre or 5 kids from the engineering school.
I'm just going to plus one. Yeah, I'm not sure I've got any brighter.
Does it start
idea.
with the deans or does it start with the students?
Well, boy, it's hard to figure out where. I think the students want it. Is the sense that I get. This, by the way, also is an interesting point on degrees and how you structure them. I can remember as a student in engineering, you need to learn so much technical stuff, but I remember thinking at the time, boy, I'm here at the University of Virginia. There are all these other great educational assets to take advantage of, and I couldn't. I was limited. by electives, but I really wanted to. That was one. But two, the other thing, talking about entrepreneurship, Mark and I spoke about this. I've spoken with students at the engineering school. That's where I'm a graduate of, and we're trying to get going on entrepreneurship. They want to take some of these commerce classes, but they're just not big enough or well-resourced enough to allow engineering school students to come over in the numbers that they'd like to. Maybe what President Sullivan's working on will begin to change some of that.
Or they found a couple of companies and they'll be able to pay for it.
Yeah.
Jack?
I think there need to be two categories of startups. There needs to be the old UVA internal law firm approach of maximizing the value of the molecule you're licensing to Merck. And then there needs to be startups that are affiliated with the university, which is take your 5 points, put them in a drawer, wish them luck. And as a lot of very smart development people at Stanford and MIT know, you're going to make a lot more money from successful entrepreneurs than you're going to make from license fees.
Larry?
I would say we will continue to do our job, is make as much money as we can with the endowment, and that'll support the greater university. So that's one. That's the most important thing. And second, I mean, I'm optimistic when I see alums like all of you that are entrepreneurs or venture capitalists, giving back to the school your time and being role models. As I said before, there are a number of role models we've had, and whether it's the hedge fund industry, more the buyout industry, investment banking. And I think that degree of role models and mentorship really makes a big difference, and will help direct more students there, and then it just becomes a self-reinforcing, a positive reinforcement.
I guess just for me, my view is really a compliment to everyone here who's been involved in the efforts here. In 2009, Tom mentioned I did spin a company out of UVA. I think it's one of the larger healthcare or certainly IT companies that's been spun out of the university in a long time, called Wellware Systems. And at the time, I think it's fair to say that some of the folks involved in the project would have felt like that they were alone. And what I've seen, at least in the last 4 years, is for the first time this university is celebrating professors that take risk. I think that's going to give the opportunity to recruit more of those great professors along the way. But to me, the more that Professor Sullivan and those of you who are in the room are celebrating it and putting a huge spotlight on it, that's going to make life a lot easier, because I don't think we can afford, certainly Northern Virginia, where most of the alumni are from UVA, and a big part of Jack and my career depends on, we really can't afford this to take 50 years, as it did in Silicon Valley. So with that, we'll open up for, I think we have time, Tom, for some Q&A.
So if I understand correctly what was said, UVIMCO is still doing a small amount of risk capital investment. Some of it apparently maybe even partnered with some of the VC companies that are here. And if I also understand what is being said about where that capital is flowing, it's still largely flowing to San Francisco and Silicon Valley and Boston and maybe the Triangle. Can you guys figure out a way that some of UVIMCO's capital can be kept at home?
Larry, you're a perfect person to answer that question.
We are going to look at the most attractive. Again, we're fiduciaries for the endowment, and we're going to look at where we think are the most attractive opportunities. If we see an attractive opportunity that is closer to home, and we certainly have made some investments that are pretty close to home. We were in Jack's last fund. We will do that, but we are not just in. We actually are less Silicon Valley focused, I think, than some others. We have a Boston, we have New York, we have Seattle. Very good fund up in Seattle. So it's not exclusively, but we again, our venture investment right now as a percentage of our total fund of assets in the ground is only 3%. And it's probably at the pace that we're committing to new funds, will probably go down closer to 2% over the next several years. And that relative to where we're using our risk budget and other assets, I think we have an ability to add more value in some of the other areas. But again, we're not abandoning the asset class, but I don't think it's going to be, it's certainly not going to be a 10, 20% portion of what we do.
So my perspective on that would be, with the caveat that I'm not sure I understand why a lot of the limited partners are chasing these billion-dollar funds, because the research is pretty clear that it's really hard, with a few exceptions, it's very hard for billion-dollar funds to generate returns. In fact, it's very hard for anyone over a $250 million fund to consistently generate returns. That all said, I would suggest great ideas. I think one of the changes in the industry, certainly since I got in, and I haven't been in it for 30 years, but I've been in it for 6, is we're on planes a lot more than we used to be. Almost every firm has gone national, and I would certainly have a preference to come down and do deals out of UVA, but we do represent our investors and pension funds, and we're investing their money. So I've yet to meet an entrepreneur with a great idea that hasn't got the funding. I would suggest we've got a bit of an idea crisis in America, and a lot of that starts with celebrating entrepreneurship at innovation centers like UVA. So I actually don't think it's a chicken and the egg thing. I think it starts with great ideas, and those great ideas getting the coaching.
I think if you make a list of the 6 or 8 key factors in building great entrepreneurial companies, money's the last thing on the list. Every time you see a government or a city or a state decide that they're going to emulate the United States because we're going to set aside money, and it's money that makes the American system work. There was no venture capital in Microsoft or Oracle. I mean, you can build a big company. I mean, we joke about it in the business, but first you sell it, then you build it. And that's the way the computer industry was built before the prudent man rule was changed and the venture business started to get big. So money is important, but it's far down the list. It's the infrastructure. I think one of the other things people don't recognize, the U.S. economy is so brutally competitive that large corporations in the United States are willing to do business with a startup to get a competitive edge against their giant competitor. Where in Japan and in Germany, where there's a dominant company, I mean, Daimler won't do business with a startup, but General Motors will. So it's just, our customers are receptive. People are willing to change jobs. Someone in Japan's not going to quit a job at 35 and work for a startup. Those are more important than the capital.
I'll throw one more out there. What role should government have in the innovation industry, if any? What role should they play? I think most of you know Senator Warner spoke this morning. We had Chopra.
I don't know about you, but my CFO just spent the last 3 weeks, and yours probably spent a man-year filing with the SEC because we pose systemic risk to the financial system. So they're talking a good game, but they're regulating us like crazy. They need to do fundamental research, and they need to recognize the taxpayers paid for it, including at the University of Virginia. So put it out there and let people build companies. But
Jack, do you suspect that the Jobs Act, which was passed, I guess, 2 weeks ago, earlier this week, which will make it easier for companies to go public, smaller companies to go public, but for those in the audience, and take the .com few years out of it, because frankly that, as in my point of view, is often the case, government sort of swang to the other side. But in the 1970s, 1980s, 1990s, 125 about a year would go public. So a vibrant public market, for those that say it's just 40 going a year, it's a bit ridiculous in my opinion. Endeca, a company out of Boston, recently just acquired by Oracle. If they had been in the 1970s, 1980s, or 1990s, they would have been able to go public at $40 million in revenue, and you'd have a growing independent company, probably called Endeca still, in Boston, gobbling up other companies. Instead, they had to wait until they were over $100 million because Sarbanes-Oxley took $3 to $4 million a year alone in cost for that company to do. If you think about that, if you're 10% bottom line, that means you need another 40 to 60 million in revenue just to afford the cost of actually going public. In the meantime, over the last 10 years, there are, as a result of this consolidation, 47% less public tech companies out there that can purchase these companies. So from my perspective, some of this change has been a long time coming, but do you think it'll make an impact?
I don't think.
How long, if it will?
I don't think the villain was Sarbanes. I think the villain was Spitzer. I mean, Wall Street. 2 things have happened that are forever. One is the institutional investors have become so large that these IPOs, even if you get a double in a day, it just does not move the needle for a $60 billion pension plan. So the institutional investors have just gotten too big. They can't invest in smaller businesses and get enough that it matters. And then the bigger issue is there's so little money to be made now trading stocks that you can't make money in your trading department to pay for research. And without research, you have no institutional interest. Research used to be paid for out of the 7% commission that they generated on the investment banking side, and Spitzer made that illegal. So now there's no research until you're big enough, 500 million, 700 million market cap, that the underwriter can make enough money trading to provide research. So that hasn't really been fixed yet. So I don't think the Jobs Act, I think it's going to lead to boiler rooms. I think a lot of old ladies are going to put $5,000 into the next Facebook. I think some of the relief is kind of on the margin. But the bigger issue, this lack of research and the lack of funds that are small enough that a $300 million market cap company that they can get enough and trade it to move the needle for them is the bigger problem.
Gentlemen, I haven't heard any mention of life sciences. Is this is this a very bleak picture for you all, or what do you think is happening there?
I think one of the challenges of most of us, I think, are technology investors. Although I have to say, I was asked before I came here by my wife if we should buy, because we have a baby coming, and we already did it before, whether we need to do the cord bank again. And I now know the answer to that question. Absolutely, yes, based on the last presentation.
She's a physician, right?
My wife? No. But I don't know if anyone that are generalists have an overall view on life sciences in general, but most of us are IT investors.
The folks I've talked to, I mean, a number of venture firms blew apart, prominent venture firms, because of friction between the tech guys and the life sciences guys, because they didn't want to share the money because they're counter-cyclical. But people just have not been making good returns there. It just takes too long. And the money, I mean, we're all decent people and we all love our work, but at the end of the day, this is about making money, and it's been very difficult to make money in the life sciences and the venture business for a long time.
One other perspective I guess I would offer up from a healthcare services perspective in IT, where I do spend about 50% of my time, is when I look at the problems in the world, there's certainly disease states that have big problems that need to be solved. But folks are living a long time right now already. And there's folks that are unfortunate, and we need to innovate in those areas so that more people in America get a chance to live a long time. The problem we have right now, in my opinion, in America and around the world, is access for everybody to that services. And to give access to everyone, you've got to make it efficient. And so it's not good enough just to have universal coverage. You have to have the ability to deliver what we already have in a cost-efficient manner. And healthcare is still one of the, education I think being the other, that for whatever reason, and it would be a very long conversation to give probably our collective views on why that is, but the information technology industry hasn't been allowed to innovate yet in the world of education and healthcare IT, and I think that's about to happen over the next 20 years. I'm cognizant of the fact that someone like me has said that probably once every 10 years, certainly in healthcare IT, but I really do believe this time is different, and regardless of who is in office in November, it may not be called accountable care, it may be called something else, but the cuts to Medicare and Medicaid are coming. It's not stopping. Our fiscal deficit is a problem. And those who don't think we already have government-run health care, in my opinion, don't really know what they're talking about. 55% of the costs already are Medicare and Medicaid. And I think the solution to that problem, much of it is going to lie in aligning incentives and then enabling it through the application of information technology.
Well, it's not just the FDA. I'm on a hospital board. I understand the business side. You can go build the greatest mousetrap in the world with all the efficacy in the world, but if Medicare won't reimburse, you don't have a business. And in our business, we can't spend 10 years finding out. Our funds, I mean, our limited partners start yelling at us after the 7th year because they want us to be done in 10.
Doug, you alluded a little bit to the ecosystem of Silicon Valley, and I know that's something that, for those of us that live in Charlottesville and work with startups in Charlottesville, is something that's always we're always compared to. And there's places like Austin and Boulder that that tend to replicate some of that. There's a school of thought sort of put forth maybe by Paul Graham as the leading proponent that those innovation hubs every day get more and more attractive for entrepreneurs, and so that if you're not an innovation hub already, you're going to have a harder and harder time creating an ecosystem that draws the best and the brightest entrepreneurs. So UVA, if we can create great ideas and drive innovation out, if we don't have an ecosystem here to keep those ideas and entrepreneurs are fungible, and we'll do what you did, which is go to Silicon Valley.
Yep.
Because the ecosystem is already there, the talent is there, the resources are all there. In that question that Kevin asked about what radical thing can UVA think about doing, or those of us in the community of Charlottesville think about doing to jumpstart an ecosystem so that in 5 years we actually have the resources to keep a lot of that innovation and those startups here instead of having them take off for the Valley or Boston or other places. Any thoughts on that?
That's a big topic. I've read the books on the start of Silicon Valley, and I've thought about how the research triangle started to do some of that. And we've just talked about how maybe that's not as prolific as people thought it was going to be. I can remember, by the way, being here as a student years ago, and I was the student representative on interviewing new deans for the engineering school, and this was almost 25 years ago. And we interviewed the guy who was then dean of NC State Engineering School, who was talking about what they were doing in the research triangle to try to start up a new Silicon Valley. And this was a long time ago, before things got that big, and how long it would take. And he thought we needed to start now. And of course, it was almost a foreign concept to Charlottesville back then. And of course, now that I look back on all the time that's elapsed, one thought is, boy, you know what? We could have taken that first step a little bit more aggressively now, and here we are 20 years later, and even though it did take 20 years, well, that went by awfully fast. So one is, I think, don't be, and I know you're not, frightened by the magnitude of the challenge, because we can start it and it can happen. I would say that's one. Two, I would say that we have not done as effective a job, I think, connecting our alumni, some of whom are well-heeled enough to want to invest in startups or help these really small startups who can be very capital efficient get off the ground. We haven't done a good enough job there. And I know that sitting in this room, clearly there are alumni who are interested, but there are a lot more that are out there in Silicon Valley. So on that, we need outreach. I don't know if that means we set up a video conferencing facility in Silicon Valley and some in Boston, and we hold office hours for UVA students who want to come in and visit people. I'll bet this, though, if you did, I bet we'd find people in Silicon Valley who would be all too excited to start mentoring students. I love the fact what you did at McIntyre yesterday. You had that, you saw student business cases, and you guys cut checks right then and there to say, all right, let's cut a check, $50,000 to $200,000, and you're off to the races. We need to take those sorts of examples and celebrate it. So I think that we have only begun to scratch the surface of really connecting students back up to alumni who would love to do it, because as we've discussed right out on these steps, secretly, we all want to move back here and do what you're doing. So blaze that trail. We'll be here with you.
I think, though, too, if you're going to start a company in Charlottesville, aside from being capital efficient, it has to be people efficient. Because the way our business model works, it's this bell curve, and we make all of our money on 1 out of 10 or 20 deals. And if you hit a Google or Blackboard, I mean, we had to hire 1,600 people in just a few years. You could not hire 1,600 people in Charlottesville in a decade, because you got the relocation issue. So you can't do a big people-intensive business down here, I don't think. Maybe in pharma or something where people move and they're going to spend their career and be a professor, but in the I'm going to have 6 jobs and I'm an IT guy or a social guy. If success means 500 or 1,000 employees in the headquarters, you're not going to be able to get them. And that's been the problem in the Triangle. They have great engineers, but they don't have management, and they don't have sales and marketing because they grew up as IBM's laboratory and Lucent's, and they don't have the full teams.
However, as we saw just last week, you can have 13 employees and no revenue and be worth $1 billion. So the thing is you don't need to have to think about building a company with 1,000 people. As a matter of fact, most of these companies, most of these startups these days are not, in the lean startup approach, are not thinking about being 1,000 people. They're thinking about being 13 people and getting a bunch of eyeballs. And I think we need to do what we did last night at McIntyre. We offered to fund three startups, which is amazing. We didn't think we'd have that much success. But the thing is, but if the kids see that this is real, that this is this is not just something that happens in Silicon Valley. It can happen here in Charlottesville. The other thing that actually Brendan went on, about a dozen kids or so from McIntyre went out on spring break out to Silicon Valley and met with a lot of the startups out there, and they came back really excited because the point is they saw how exciting it is. As a matter of fact, I'm thinking about moving out because your job sounds even more interesting in trading. Although I do live less than an hour from Melbourne, and I love it. So I'm not sure that's my decision. But the point is, if they see it's real, and you get them excited about it, because in Charlottesville, the only thing they do is they go up to D.C. or they go to New York and work for Goldman or whatever. They don't see the exciting lifestyle and the fun and the energy that they have on the West Coast. So those are the kind of things that we need to do, and then we'll build that whole mentality that they have on the West Coast. It takes time. You can't do it. Won't happen overnight. Won't happen in a couple of years. It'll take several years. But if we try and throw spaghetti at the wall, which is like being an entrepreneur, there's no bad idea. Open grounds. It doesn't matter what it is. We got to keep throwing out ideas out there and see what sticks and what the kids want. And then if we get them excited, the rest will take care of itself.
I guess I may have this may be a contentious point of view, but I don't think it can be about Charlottesville. If you're open grounds, you're open. And I don't think there's a university in America today that's going to be around if they're only thinking about, if UNC is thinking about Chapel Hill, Duke's thinking about Durham, MIT's thinking about Kendall Square. I think you've got to think about not keeping them. That doesn't tend to work either, right? It's sort of a mentality change, which is, how does this become the heart where everyone wants to come back? I mean, what got Doug wanting to come back after all this success? And so I think it's more about connecting the dots. There's a lot of Kaufman research out there that also says and suggests that concentration in cities matters. Northern Virginia is huge now. And I think the one thing we have going in the Mid-Atlantic area is we do have unbelievable institutions of higher learning. We've got the University of Virginia, we've got Virginia Tech, we've got Hopkins, University of Maryland, which has come a long way in 20 years, And the thing going against us is geography. Right, at MIT and Kendall Square, I refer to it as the retreat from Waltham. All the venture capitalists are now moving back down to Kendall Square because within a mile radius, everybody's there. But that's just an excuse, in my opinion, these days. So I think it's connecting the dots. Even up in Northern Virginia, product managers that I used to know on a first-name basis and get together for drinks all the time in Boston were hiding in tree houses. They were in Ashburn, they were in Vienna. You couldn't find each other, and God, the traffic was so bad. And getting down to Charlottesville on Route 29. Well, now you've got things like the Metro and others, but it doesn't matter. I mean, I sat in the Omni for 5 hours today on a board call on a company that's all the way up in Waltham, and one of my conclusions was I was probably more effective on the phone than I might have been had I been in person. And so I think it can't be about Charlottesville. It's got to be about the University of Virginia, and it's got to be bigger than Virginia, a lot bigger than Virginia. It certainly was for Jefferson. Right? He bought the Louisiana Purchase. Sent these guys out west.
We started a company together in Atlanta, and I mean, tell the story and why they're not in Atlanta anymore. It's real simple. No, that was for you to talk about, but we went.
Oh yeah. So this is a good. So Solid Fire. It's in the storage space, which is one of these hot areas where you get an idea and glow in the dark talent, and the valuations start skyrocketing before you really even have I think we're still in beta product, but Jack and our two firms, Novak Goodall and Valhalla, put $1 million seed investment, $500,000 apiece, into a Georgia Tech spinout. And there are two areas in the country, frankly in the world, to build storage companies. One is San Diego, and the other one is Boulder, Colorado. And we ended up going to Boulder, Colorado, because we had mutual portfolio companies there where we had good success, and were able to recruit 30 people right away in a couple of weeks from this company called Left Hand Network that HP bought for about $350 million.
Listen, one guy who this is one of the old timers, but I talked to him last week, Jesse Ueda. He started Source Technology, created lots of young millionaires. They started companies, and Boulder's for real. So, and then Washington D.C. now, the reason it's become this education center is because of the Blackboard guys. So if you can get a big win and create a lot of young millionaires, then you have critical mass to have a field of expertise. But we literally moved this company to where the people are, which in this case is Boulder, because of one guy who started a company 42 years ago.
And I don't think that's, by the way, and I won't name any names, but some at Georgia Tech think this is a really bad thing for the state of Georgia. I disagree. Those guys will be back, and they're going to be back, and they're going to be really, really wealthy. So I think figure out what you're good at this university, what you're not good at. Maybe you recruit people in terms of what you're not good at, because you've got a heck of a brand here. Who wouldn't want to come work at the University of Virginia? And then think of the world as sort of your oyster, but don't think of Charlottesville alone. I missed the first part.
Actually, last night, it was basically angels that did the funding. I'm coincidentally having lunch tomorrow with another group of well-to-do people in Charlottesville that also want to form an angel group. So yes, I do think that the angel groups are probably the biggest hope for Charlottesville, because there isn't much domestic. There's one sort of domestic VC right here, but the thing is, there are a lot of people who want to give back, who were the people who well-to-do people who live around Charlottesville. Almost most of them went here, and they want to give a little bit of their time. They want to give back. So yes, the fact that 3 of them wrote checks last night, and that we're meeting with some more. And by the way, 2 of those guys were in the audience that I'm meeting with tomorrow. I do think that is going to be the thing that catapults us to the next level. Now, hopefully, 5-10 years from now, we'll get some more VCs here and grow a larger infrastructure. But in the beginning, in the first few years, I think it's people who are willing to write those checks and maybe even take a little bit more risk than they normally would to get the infrastructure going.
Sure. Sure. Well, I'll offer 2 perspectives and chime in if you guys have your own point of view. My first point of view, when I was at IBM, the study came out years later after this happened, but we started going virtual as an employee base, and now IBM has something like 420,000 employees. It's unbelievable how big it is at this point. And we were building a new campus in Research Triangle Park. And I guess the research proved that once an organization of that size went to 20%, it shot to like 90% working virtually. So I walk in on opening day, and I just hired a new employee and was trying to find a cube for her. And there were a lot of open cubes, but some person in Armonk, New York was telling me that all the cubes were taken up by somebody else. Well, even the people that live there stopped coming into work and were working from home. One of the things I found challenging as a manager of there was 50 folks, of which 2 I would see on a daily basis. I would go to a conference and I'd hear someone talking to me I'd worked with for a year and a half, and I'd recognize her because of her voice. Was that no one really is teaching students how to, and managers, frankly, and leaders, how to work in a virtual environment. So that would be one opportunity. I think there's a lot of opportunity to teach America on how to operate that way in an effective way. There's also some research that suggests, I think out of Harvard, that, in fact, I think both of these pieces are out of Harvard, that you can be more effective when you're not sort of in the same building. I'm not sure I totally agree with that. But it also says that the further away a venture capital firm is from its investment, the better the investment ends up being. Which is pretty interesting. You know, maybe it's because you know you're going to have to fly out there if every time it's not working. But when I look at some of the venture firms that have gone to satellite offices, and a lot of them have, our firm's certainly thinking about that. You know, all of us being in Northern Virginia just means we're always going to be on a plane. Maybe we should be in California, Boston, and New York as an example. When I look at the firms that have done that well, they all, at the heart of it, have an incredible telepresence technology. And the telepresence technology, when I was living in Hong Kong in 2000 versus what it is today, is night and day. So I think you're onto something. If you become an innovator in the heart of something, there really is no excuse, except for maybe you may have some deans to convince to make that investment so that you can celebrate what you're doing and connect the dots around the country and stop thinking just about within the walls, sort of closed grounds instead of open grounds. That would be my view.
Just have one little thing to that you mentioned that being farther away was helpful. In the forefront of venture capital, what I do is actually I look at tons of data and analyze it. And there's a new venture capital firm out there called Correlated Ventures that not only discovered that, but they also discovered that ventures do better without a venture capitalist on the board, and so they don't take board seats, which is sort of the antithesis of what a normal venture capitalist thinks. So I think that looking at data, big data, even in this field, is going to be one of the big ways of the future. But to figure out that being further away and not taking a board seat are good things. That certainly you can ask. 5 years ago, you could have asked 100 VCs, and not one of them would have probably given you those answers. So,
well, venture capitalists love creative destruction, unless they're talking about themselves.
Exactly.
We did an interesting study 30 years ago when I was working on Wall Street. We did a postmortem on a whole bunch of software mergers and acquisitions, whether they succeeded or not, looking at them 2 years later. And we looked at customer overlap and synergy and this and that. There was only one thing that positively correlated with success, and that was geographic proximity. If the companies were close together, the mergers were usually successful, even if they had different customers, different technologies, different markets. And if they were far apart, the mergers generally didn't work.
Usually close to where their CEOs live, right? Any other questions?